Hello and Happy New Year, everybody. It is Ronnie, and I'm here today in 2024 on Wednesday, January the 3rd. So third day of the year, technically second trading day of the year, and we are already in a sell-off. And the Santa Claus rally hasn't really fully come to an end, technically. So as you can see from the chart here, this is the S&P 500. We've had a couple of days, 3 days now in a row, technically 4, of a sell-off in the market. And really, I mean, it's probably due. We've had quite a bit of a run-up. You can see this is a daily chart on the left of the S&P 500, and it's been, 17, 18% from the bottom there. So it's not surprising that there's profit-taking happening. It's in pretty orderly fashion right now. The volume isn't terribly, extensive. It's not like a panic sell mode, at least not yet. And, you can see on the monthly chart here on the right that we looked at last time that, it didn't quite get to that all-time high. It got pretty close and then it's backed off. So, whatever it does next, I probably would anticipate a little bit more of a pullback before any kind of return to the upside in this market. We have a couple of things, going for the market, but I feel like we have a little bit more going against it from the perspective of an economic conditions. So we'll talk a little bit about that today. But what I wanted to start with is just kind of an overview of the three major markets in the U.S., and then the kind of sell-off and what it's showing, what the internals are showing, what sectors are doing, where the rotation is happening. Because what I think is happening, or what I can see just from looking at the different sectors, is that it's not really just a liquidation of the full market. There is some rotation going on into some sectors that are more defensive. And so that gives us an opportunity to potentially still be long in the market during a pullback like this. It's even if it tends to broaden out a little bit. So what I'll start with here is the S&P 500, like we've talked about. So again, it's up about 17, 18% for the year. I'm looking probably, if you put a Fibonacci on this, I'm looking probably at a retracement at least back to the 38.2, if not the 50. So I don't have the 38.2 on here. Let's go ahead and put it on, and you can see what I'm talking about. And so, I mean, it's not really that much of a retracement in this large up move to come down into the 4,500 to 4,550 area. So, where this kind of level of this area of consolidation is here before the last up move in the market is a pretty mild expectation of a retracement from this type of a move. So this is what I'm targeting, this kind of area down here. It is below the 50 moving average, but I haven't included the 100 here. It could be closer to the 100 moving average, but I don't think it's going to, I don't know the future, but I don't believe, unless there's some catalyst, that it's going to be just a drastic move in the next couple of days to weeks. Probably, grind down a little bit. You might see, some up and down movement here, but this is what I'm targeting, this 45.50 area near the 38.2. So, and what I'll be looking for there is maybe a bounce in the market, a potential to get into some shorter term longs, for a week or so as the market retraces before the next downturn. Because I think we probably do have either, if you look on the right here, either a little bit of a choppy market before it goes back up, or even, potentially a move down a little bit further here. But regardless, you can use things like your Fibonacci retracements to give you some decent targets to look for. In addition, of course, sometimes to the moving averages as well. I'm not the biggest fan of moving averages as much as I am of Fibonacci retracements or technical consolidation and patterns in the technicals, which seem to be more consistent, I guess, in some charts, especially in the broader markets. So that's the S&P 500. Let's take a look at the Nasdaq real quick. And this is, I think, where kind of it all started, if I'm not mistaken. If you take a look at the daily here, you can see there was a pretty big gap down on Tuesday when we opened, and I think that had to do with Apple, to be honest. Apple had some bad news, downgrades, I believe, and you can see that it did impact the Nasdaq considerably. And we'll just show you Apple real quick so you can see what I'm talking about. So here's Apple. You can see Tuesday's move. Today's kind of a flat day on it. It's down a little bit, but it's not, as down as much as it was yesterday. But it did have some news. You can pull the news up from your live news section. This is Thinkorswim. And, it did have some downgrades, in the stock on Tuesday, which caused the stock to fall below its 50 moving average, actually. And it's kind of, taking a break today a little bit. Still down, but taking a little break. But as you can see, it did actually on the monthly, it did get to an all-time high before the holiday. But that kind of candlestick pattern is not the most healthy, right? This what's called I believe a doji, where it's just a really compacted kind of pattern here on the daily, usually signaling uncertainty, right? So it ended up coming straight down from there, and it hasn't surpassed that 199.62 area. So Apple, I think, kind of started some of the selling, at least from what I can tell. I'm sure that there were other things. Obviously, we had some economic data come out that we'll talk about as well. So we can go then finally. I'm going to actually look at the Russell because we had talked about this and potentially being a makeup trade, right? As we go into the new year, but it obviously has reversed from the high it made last month in this area here, this high. It's reversed back from that quite considerably. You can see it's big down move today in the Russell, down to more than 2.5% today. So it's following suit of the market. It's also likely because there are some economic factors in play as well. There's some economic news that came out that could have affected the Russell 2000. So for this, I really I don't think that it necessarily will be a makeup trade, especially with the market rolling over. So we're gonna have to wait on the small caps to see what happens there. January, like I had mentioned, is technically or historically rather, they're better times. There may be some pockets that we can talk about, but I don't think broadly it's going to necessarily be just a massive, push in the small caps this January. So, okay, so those are the three kind of markets I wanted to talk about. And I wanted to also show you all the VIX because this really is interesting still. So even though the markets have come down a few percentage points and relatively rapidly, you're still not seeing that much of a massive move in the VIX, right? So we talked about it being pretty low from the perspective of historically, it's very low. It has crept up a little bit in the past day, obviously, with the market. But, in reality, it should be between 18 and 20 before we see. So being this low, it's usually more of a top in the market, or at least a short-term top. So if it starts to push out of this area going into, 16, 17, 18, up to 20 even, it won't be, if it starts moving that direction, I'll look for it to make a turn back down unless there's some big liquidation event around the 20s before I start to think about getting back into, more broadly the S&P 500 and Nasdaq stocks. And that is because, as I mentioned, there is a bit of a rotation, right? So right now it's not necessarily like a full liquidation yet. I don't know if that will happen or not. There are lots of things happening in the world, as we talked about last time as well. But if you can, see where the VIX, just keep your eye on the VIX. If it seems to be pretty tame right now, but the VIX in other areas, if you look at the sectors of the market or even stocks, you can look at the VIX in the Nasdaq, right? So this is the volatility of the Nasdaq. It's a little higher, but it's still not in the 20s, which would be more volatile. But if you look at the volatility on Apple itself, that's pretty interesting, right? So we talked about Apple kind of being the catalyst for some of this initial couple of days of down moves in this market. And you can see that's a pretty huge jump for a day of volatility in Apple. So that's something to keep an eye on too. So even though the whole market's volatility isn't up there yet, is this a leading indicator? I don't know. But what we can do to check out where things are in the market as from a sector perspective is look at the market sector heat maps. So today, this is an S&P 500. Sorry about that heat map. And you can see most of the larger information, like the technology, consumer discretionary, industrials, real estate, staples, they're all down. Even financials are mostly down as well. There are some pockets. But like I was talking about, there is rotation happening because you can see in healthcare, which is technically a defensive sector, usually a defensive sector, it's starting to look like there's some buying going on in healthcare. As well as, I believe, utilities. I don't know if you can see it on this map, but let me go down to the utility sector. So yeah, so you can see also there's more green in the utes than there are in something like technology, for example. So you can look at the same thing within the Nasdaq. You can kind of see, you can open up each of these sectors if you wanted to and see kind of what it looks like internally into the market internals. And in the healthcare sector, there is, at least with the big healthcare names, there's some buying. But areas like real estate, like technology, like consumer discretionary, there's a lot of red. So my point here is there is a rotation happening. It's not like a full-on, crash at the moment. So there's some opportunities. So what I'm looking at, of course, there are some opportunities in SPX to the downside. We talked about the SPY. So if we look at it from SPX, you can buy SPY calls or puts. You can buy options on the S&P 500 by looking at SPY, which is the ETF, and you can buy options on that. I like looking at the SPX from the perspective of just, the actual levels because it's the actual market. And so what I'll be looking at is if the market does kind of come back or stabilize out here for a couple of days, I'll be looking at some puts in the market down to this 45.50 level. So in the SPY, let me just open it up. I don't know how marked up the chart is. Okay, that's good. Yeah, so I'm looking at buying some puts here, and I've put an order out there already to buy back a call spread that I had put on. So I have a call spread for January. Sometimes what I'll do is if I don't want to go into puts directly, I'll sell call spreads. So I do have 2 call spreads on in the SPY already. And if it stays, it stays below this 475 area, those call spreads will either expire worthless or I do have an order to buy them back lower. But what I mean to say is you can buy options on the S&P 500. So my next step would be any little bit of a bounce in the S&P 500 should bring the option prices down for puts. So that's one idea that I have is puts in SPY for the first quarter, basically for March. The second thought, that I had was to kind of buy defensive defensive things on dips. So we talked about the dollar and gold and oil last time. So what I'm looking at, I am looking at gold, and today I actually bought some. If you look at the gold futures, so you can, I do have some alerts, but you can see in a general sense, gold has been consolidating in a big range, and it's at the top of that range. And I'm thinking it's gonna break out to the 2,200 level for the medium term. So I actually had an opportunity on the daily here. You can see kind of it's had some kind of higher highs and higher lows, which is a bullish pattern. And today, it did go down quite a bit. It had a pretty decent down day in gold. And so I went ahead and bought some gold in the way of gold GLD, both GLD and GDX, which are gold miners. And the reason I picked GDX as well is because it's, kind of a more volatile, I guess, and will probably give you like a little extra juice in your trade. So this is the GLD. And then the GDX, let's see if I can pull that up for you as well. It's probably very marked up. I should plan better. Sorry, guys, I'll get better at this. So GDX is the gold miners. And you can see that it went down a little bit more than GLD today and gave a better opportunity for entry here. And so you can see it's kind of in this, pattern where it has a higher, it's first kind of higher low on the monthly. So if it's able to kind of push out of this range here, this kind of wedge pattern, I can draw it for you if you need to see a visual. So I'm not going to be perfect here. It's kind of a wedge, right, on the monthly. So I am buying gold through the gold miners with the expectation that it's probably going to push through this wedge and go up into the like maybe high 30s, low 40s, maybe like right around here. My target for GLD, and again, you can easily do what I was talking about before, just throw a Fibonacci on it. And so actually, I like the 36 area better as a first target. This is a monthly, so it's a much more longer term. So it gives you really good perspective to put a fib on it, so Fibonacci on it. So I think in this area here is where I'm targeting as my first target. And for gold itself, so if you look at the futures, back on the futures of gold, you can see, it's already way up here, right? So it's already pushed up. GDX is not actual gold, it's gold miners. So it goes with the market sometimes as well. So for gold itself, I would expect that it probably make at least hit 2,200, but probably what I'm looking at, I'm going to show you this area here that it has moved into, right? So like it's been moving in this kind of range over the past couple of years, right? So this is since 2020. So it's been in this up, down area. And so what I think could happen, at least half of this move, I think it could push out. It's likely gonna be dependent upon some geopolitical stuff, dollar pricing, etc. So I'll be keeping a close eye on that. But even if I were to break this in half and just take half of this move and just, let me duplicate this box, right? So if I were to duplicate this box and put it up on top and say that's, kind of a measured move, let's say the amount that this particular range covers, if it moves the same amount, that will take it to 2,600. I think that's being a little aggressive, but I'm pretty conservative. So if I were to say, okay, let's even just look at what does half of that look like. So I'm just going to estimate here for the moment. But half of that goes, up to 2,300, which, in the scheme of things isn't very, very much extra. It could technically still stay in this range. It could just kind of come back down and go into this range, but I am betting on, my bet is going to be according to the dollar pricing. So if I were to look at the dollar, and it has to do with the macro environment, the economic environment. So if you think about, this is of course my hypothesis, not advice, but if you think about what's happening with the with the economy. The interest rates potentially, like the prediction is that the Fed's going to cut in some interest rates, which should bring the dollar value down. The dollar value going down usually means gold can go higher. It also, the market coming down means also that gold could go higher. So these are not definitive trends, but they're historically relatively good probability. So I am using that environment and what the market thinks is going to be happening with the interest rates to drive my gold trade. And so again, we've got some higher lows here and higher highs. And so I'm just going to kind of follow this shorter term trend. If you look at the daily, this shorter term trend until my target is actually 2,200 for the short term. So that's what I'm looking for in gold. Now, speaking of interest rates and the dollar, so just taking a look at the dollar first, you can kind of see using the Dixie, it has been kind of coming down on the daily. You can see it's come down from its high of 107 is its more near-term high, previously 114. It's come down quite a bit. So the last couple of days, it's gone up a little bit, which has, caused gold to come down, which has given me a buying opportunity. So again, if it tends to fall, it's still lower highs, lower lows. So if it continues to follow this pattern, and unless it breaks out of this pattern, I'm sticking to my hypothesis there. And so additionally to that, let's look at the TLT. TLT being bonds, 20-year. So, we've noticed an upswing or a bounce in the bonds recently because of the expectation that the Fed is going to cut interest rates. So while I don't think that bonds are just going to blow out here, they do have the potential to at least make kind of like a short-term lower high. You've got a lot of things that you can target. I'm pretty conservative, so I'm going to use the 38 to this area, somewhere in this area here, underneath that 200-day moving average. But that's still a pretty significant move for bonds. So March, because we're going to have to plan. This is monthly, right? So there's 2 more of these bars. That's it. Gets you to March. So March is the next Fed meeting and the next decision that's going to be made on interest rates. So I feel like it's probably going to continue going up until that date or that close to that day because of the expectation, unless something drastically changes. People think that the Fed is going to be cutting. I believe we had one European country, and I just right now can't remember it off the top of my head, that just cut interest rates. I think it's the first one. So I think the expectation is that the Fed's going to follow their conversation that they had in December with us about potentially cutting interest rates. That was a discussion point in their meeting, which they had not said before. And so the Fed futures, Fed fund rate futures show the expectation of cuts. So with bonds, you could potentially buy some bonds here. And so my second kind of idea, additionally to the gold trade, is to buy some TLT on any kind of pullback. So this is the daily on it. It's extended quite a bit. So I'm going to wait. Today was a good day to buy if you could get it below at the low of the day. You could have bought a little bit, right? Dollar cost averaging into it. I'd like to get it closer to the 94, 95 area if I can. So I'm going to wait a couple of days, see what happens, and potentially try to get in to a TLT trade a little bit lower. I'm going to have some patience on this one because, as you can see, this thing is a volatile on the daily. So that's my second idea there is kind of TLT long based on this expectation of rate increases. And kind of the third thing that I wanted to talk about, and the last thing that I'll talk about today, it's already almost 30 minutes, this video, so I try to keep it short, but I like to talk, I guess. So sorry for being not so succinct today. So the last thing, let's talk about the last thing here, which is oil. I talked about, I'll go to XLE, oil stocks. So crude oil itself, let's actually go to crude oil first, because it had a day today. It went up. We talked about crude as a short, right, on my last video. And I'll just zoom in a little bit here. Basically I was like, if it can get below this last monthly bar, it has the potential, to go down further to maybe around 60-ish, 60 something. Now I know that there's all kinds of macro stuff going on in the background. There's geopolitical things happening in the Red Sea. From a macro perspective, technically the U.S. is supposed to replenish the reserves, our strategic reserves, if it gets below 70. So there's a lot that can happen. But what I was speaking to is this kind of trend line and the potential of it being resistance. And that's the longer term. So like on the short term, it did bounce today. So it have a really big bounce today. And I actually took some XLE puts. I bought some XLE puts today. We talked about how I trade crude oil, long or short, is through the XLE. You can do it through USO as well. But so I used this opportunity today. And crude on the daily is a little hard to look at. So, looking at it on the weekly, even, this is month on the right, week on the left, there is, yes, it's a higher low. A higher low, but we're still kind of in this downward trend. So I'm expecting it to stay below this last month's high and kind of roll over again, just based on the economic environment. And so what I have done is buy a put in XLE, and let me just pull up XLE so you can see. And so I did take the opportunity today. Here's the daily in XLE to buy a couple of puts for March. So I'm buying, all my puts are buying. I'm buying to the March. I'm doing it longer than I usually do. Mostly I usually do about a month or so out. But I'm doing it a couple of months out to give it some time, just because of the environment that we're in right now and kind of uncertainty as to one way or another on some of these trades. And I want to see how the next few weeks pan out, but I don't want to completely miss out on it in case there's a move. So I've kind of nibbled into some of these positions, and I don't like that word nibble. So I have gone in small, and so partially going into these positions so that I can save some capital to go in a little bit bigger if the move ends up panning out. So I do like to kind of do an initial position and then get bigger down the road. So that was my last idea for today. I have several things that I'm looking at. I know we talked about Amazon last time and some other things, but with the market rolling over, I think I'm going to stay away from tech on the long side, even though Amazon looks like a longer term decent makeup trade for tech. So once tech comes back, I think I'll probably get into Amazon, and that may be months away. But for now, I think I'm going to stick with these defensive names, and we'll get into a couple of more in my next video. But for this week, let's see where it takes us. And I will, on my next video, get into a little bit of the economic data. I know I said I would do it today, but it's been 30 minutes, so I'm going to stop now. And I look forward to speaking with you all next time. Have a great day and Happy New Year again. All the best.